whenever we are doing any trade like intraday trade or any positional trade, our money is not protected. We do not know the risk associated with our money. We may put some specific stop loss, but that doesn't mean that we know the risk. So here, as an option strategic trader, you will be knowing well before what is the risk in my money, means below which point I will incur the losses, above which point I will be having a optimum profit. So you have a perfect scale measurement. If this position is going to give me the success, I will earn this much. If this position is going to give me it goes against my viewpoint, and if it is giving me the loss, I will be incurring this much of losses. So your liability and the reward both is well scaled and well informed to you before you initiate the trade. That is the benefit of this option strategy. So in this context, lot of strategies are there. So those who are quite matured option strategic trader, many of you will be the matured option strategic trader, many of you will be the newcomers also. So for all, option strategy is being divided into two categories. One is the basic strategies, and another is the hybrid strategies. So second category is hybrid. So basic strategy, whenever we talk about, that is a bull spread, bear spread, strangle, straddle, gut, condor, iron condor, like that. Conversion also one of the basic strategy. Whenever we combine both, we combine a bull spread with bear spread, bull spread plus bear spread together we are taking bull and bear spread. So whether it is net credit or debit, whatever may be. So this combination of the strategies, basic strategies, are known as the hybrid strategies. And these strategies can be initiated with different objective also. They have a specific objective associated with that. Whenever I am saying that market is highly volatile, just I will come to the point of volatility. So just I will be giving some conclusion on the market. I do not know, I have not gone for any calculations or anything. Just I am giving market is highly volatile. This is one of the conclusion I am giving through some process of my mathematical calculation or whatever may be. So this says volatility is high. If I can form an option strategy with volatility neutral, then my money is protected. It is high volatility. So high volatility may result the losses in my money. My money may be exposed to the high volatility. My money, if at this point of time, this information says market is highly volatile. At this point of time, if I am investing 1 rupee in the market, that 1 rupee is exposed to the volatility risk. If at any way, if I can make this money to be protected from this volatility, then we can say that volatility neutral, and that kind of strategy can be formed through the options. So you form all the strategy which is Vega neutral. Vega neutral, it is known as your volatility neutral. In a high volatility condition, if you form a Vega neutral strategy, that says from now onwards, if volatility is in the higher band now, if it goes up further or maintains in the same high volatility band, then my money will not be lost. my money is protected from the Vega neutral by way of forming the Vega neutral strategy. Similar way, options used to start from the beginning of the month, and the day of settlement they used to surrender all time value. So option premium will be having two components. One is the time value, another is the intrinsic value. So by the end of settlement, all this, once you near towards the settlement, the time value will become 0. On the day of settlement, it will be absolutely 0. Suppose you wish to protect your money from this time value neutral or time value decay, you can form theta neutral. Theta neutral. So I have told you Vega neutral, theta neutral. Similar way you can form delta neutral. Similar way you can form any of these Greeks neutral. Theta, Vega, gamma. So many Greek neutral strategies you can, omega. So many Greek neutral strategies you can form. So Greek neutral, if I will talk about, it will become much complex. So I will not talk about the Greek neutral approach. We will just discuss one strategy, and with the help of integrated tool, I will be disclosing how you can make a profitable trade decision using the option strategy. So this is what I am going to, this is the aim of my session today. So here I have told you options having two types, another one is basic, another is hybrid. Options strategies can be formed with a specific aim, means in a high volatile market you form Vega neutral. Option time value is going to decay, so you are forming the theta neutral. So what does this neutral means? Just to spend a little bit of time in this. Say I have just taken one 5,200 put option 34 rupees, and currently it is quoting at 34 rupees, and 20 days I have left till expiry because I have taken the Friday's price point. So if I'll press the button, I'll calculate. It is giving me specific values like delta is minus 0.2492. Omega is this much, Vega is this much, theta is this much, some values it is giving. So let us consider the value part of delta. Delta. So delta is 0.2492, 5,200 put option, currently at 34. Delta is minus 0.2495. So this is what it is showing. So how I will translate what is the meaning of this? This says delta is associated with the underlying asset value. So underlying asset is Nifty. Nifty is the underlying asset. So just give me a couple of seconds. Just give me a couple of seconds. Here delta is 0.2495. What does it mean? Nifty is at 5329 now. 5329 now. This says this is a put option. This is a put option. If Nifty goes up, put option will decay. So this you know. So Nifty is going up means this put option value will fall. Nifty is falling means the put option value will go up. So this is the nature of the put option that all of you know. It has a delta of this one, 2495. This says if Nifty goes up by 1%, very carefully listen this one, 1%, the put option will decay or fall by 24.95%. 95%. If Nifty is plus 1%. If Nifty is minus 1%, fallen by 1% with respect to the intrinsic value, this put option will go up by 25%. So you can say one lot of money if you are investing here, so which is 34 into 50, your money can reduce by 24%. So into 24 divided by 100, and this must be subtracted from here, this minus this one. If Nifty goes off by 1%, your money will become 1292. Similarly, if the Nifty come down by 1%, your money can increase by 24%. So 24.95 multiplied with this one divided by 100. Your money can become 2124 or 1292 if Nifty is gone off by 1% or fallen by 1%. So 1% of Nifty, which is, you can say, around 53 points it works out. So 53 point movement in the Nifty in the upper side will reduce your money by 24%. 53 point down move by the Nifty will increase your money by 2124. This is the meaning of the delta. But I don't want this much of high fluctuation of 24% decay, 24% optic. I do not want. I need my money. If Nifty goes off by 1%, I need to gain 1% in the option. Similarly, if it come down to 1%, I want to lose only 1%. I don't want to lose 24 and get 24. Because if it goes against me, if 5 trades are gone against me, then all my capital will go off. I will not have any capital to trade. If 4 trades are non-favorable trades, then I will lose entire capital. It is 24%, 4 times of defeat will take out all my money. I will be landed with 0 money to trade. Henceforth, this is a high risk trade. I do not wish to take this one. So how I can do it? So by this process, it is 34. Having a delta of 2495. At any way, if I can reduce this delta, which is minus 0.2495, if I can reduce it to minus 0.01000, then I will say that yes, Nifty has gone up by 1%, I will lose 1%. Nifty has fallen by 1%, I will gain 1%. If I can reduce, how I can reduce? By the way of buying a call option, by the way of selling another put option. So that is called your strategy. While forming the strategy, we are reducing the risk associated with the money. So this is what I have explained you, what is option strategy and why the option strategy is being taken. The option strategy is taken with the aim to reduce the risk on your capital. That's all. So now moving to our today's session of option strategy, wherein we will be discussing one strategy, particular strategy known as conversion. We will form a hybrid strategy with respect to the conversion. So now come to this conversion strategy. What does this strategy means? First you understand the strategy. So buying or selling a future along with selling the same strike call option and put option is known as the conversion strategy. For example, if we are selling Nifty future or buying Nifty future, any one thing you can do. Either you can sell Nifty or buy Nifty future. Along with you are selling a 5300 call option and put option, each one lot. Then this is called as a conversion strategy. So in which kind of market this strategy is being taken? This strategy used to be taken with the anticipation of a range bound situation. What is range bound situation? As I told before, in smart finance, we never say anything which doesn't have a mathematics. So range bound situation means it is a low volatile market. So low volatile market means as long as Nifty's annual volatility is less than 20%, I will say that it is low volatile market, and I will say that this is corresponding to the range bound market. Moment it will move above 20% of the band, then I can say that we have entered to the medium volatile market. Moment it will move above 40% of the annual volatility band, I will say that we have entered to the high volatility band. This is the view in which this strategy is being taken. But only by taking this strategy you will not get benefit from the trade. Risk, what is the risk? If market turns to be volatile, highly volatile, after the position is being taken or this position is being initiated, then this strategy will yield losses. You do not know how the market will behave after you initiate the position. It may become a medium volatile or high volatile band. So this is the risk which is associated with this particular strategy. So that doesn't mean that since this part of risk is there, we can't able to make any money in that. No, not like that. We can able to make very good money in this if we convert this strategy to be a hybrid strategy. Means we have to combine some more strategy with this to make it a hybrid strategy. So how I can make it as a hybrid strategy? So here I have just come over with some specific strategy. Conversion, you understood. Conversion with multiple bull and bear spread we can form. Conversion with multiple deep out of money call option and put option purchase. If we can do this kind of combinations, if we can add this combination with this conversion strategy, then this strategy can yield a wonderful profit and we can get excellent profit out of that. So here I have I am going to backtest this strategy for you. I have taken the first case, conversion with multiple bull and bear spread. This is what I have taken. So the first case, we are going to backtest this strategy for the entire month of June. So 1st June to 28th June we expect. So for this entire month, for the entire month of June, we are going to backtest this strategy and then we will decide whether to take this strategy or not. So I have decided to purchase because there was a prolonged period of correction was in the market and Nifty has drift down to 4,800 level. So there was this hefty correction happened. So we thought let us purchase the Nifty future on the very first day of the 1st June, which is the new settlement cycle starts. We sold 4,800 put option and call option. By this process we formed a conversion. Then I have to form multiple bull and bear spread. So how many lots of bull spread and bear spread I will form? That depend upon how much money I have received. So by this process I have received 125 into 50 plus 138.7 into 50. So this much of money I have received. So 13,185 rupees I have received through the sale of these options, and I have the Nifty future in my hand, which I have purchased. So by this process, my Nifty future is protected by selling of the call option and put option. My Nifty future is protected 4818 added with 125 added with 139. So my protection in the upper side is 5082 and in the lower side I am protected till 4818 minus 125 minus 139. I am protected till 4554. So till this point I am protected in the Nifty future by the way of selling these two options, one call option and one put option. And I received some premium of 13,000. This 13,000 money I am going to invest again in the option premiums to form the multiple strategies. So here 5 lots of bull spread I have formed. I bought 4,900 call option. I sold 5,000 call option. So by this process, in one lot, I am paying 37 rupees, and 5 lots I have taken. So I have paid 9,000. So bull spread, I have invested 9,250 rupees. And again, from the bear spread, because 4,800 strike already engaged, so 4,700 strike and 4,600 strike, I have invested 89 minus 62.8 into 250. So I have invested another 6,550 by the way of taking 5 loss. So 15,700 rupees, 15,800 rupees I have invested. I received 13,000. So net I have not paid much time value to the market. Whether the audio connections is okay for all of you also. So by this process, what happened? We have invested 15,800. We have got 13,000. So in the premium front, we have not paid much to the market. We formed this strategy. See, this is the 1st June till the 28th June. Every day's record I have taken. On the 4th June, which is the following trading day, we have got a net profit of 2,382. By this process, the profit has touched the 16,000 level at 5127 level, which is on the 13th June. Then it has gone to 18,527 when the Nifty was at 5129 level, and the end of the settlement cycle, we have landed at 22,025 as a profit. This is every day basis. I have just tracked it. Every day basis. So this is one of the conversion with multiple bull and bear spread. See the next alternative of conversion, alternative of hybrid strategy. Next alternative hybrid strategy, conversion with deep out of money call and put long. So same way, future purchased, sold the call option and put option. We bought 5,000 call option 2 lots. We bought 4,600 2 lots. Why two lots? Because by this process 13,000 I told you, 13,000 plus we are getting the premium. This much of money I am going to spend. I am not going to spend any 1 rupee more than this money. Means this is a maximum money I can spend. But in the earlier case, since I was forming a strategy, I have just gone for some 1 to 2,000 rupees extra I have spent there. So here I am going to purchase the options. I am going to pay the time value. So by this process, how much I have paid? Into 100. So 5,000 I have paid. So here 6,000 I have paid. So 6,000 I have paid. So by this process I have paid the time value, because it is all are out of money. I have paid 11,293 as a time value. 13,000 I received through the sell process. So net I kept some 1,000 rupees balance in my hand. So I just kept some amount of money in my hand. So by this process I have invested 11,000. I received 13,500. This is what I have done. See the performance of this strategy. Very next day, it was at 1,000 rupees profit, and the day end it was at a 15,695 profit on the day of settlement. Assume we have done the wrong thing. Instead of buying this one, if we could have sold this one, sell Nifty if we could have sold, then what will be my liability? So first case you have seen 22,000 profit. Here you have seen 15,000 profit. Both the cases Nifty was a purchase. Instead of that, if Nifty could have been a sold position, so this minus, if I could have sold the Nifty, so then this position will be at a losses, and if I can take all these days into account, then my losses will be around 17,405, because since I purchased it, it has given me this much. If I could have sold it, then in the second alternative could have given me 17,405 losses. Since it has rewarded 15,000. Now the first alternative, if I could have sold it, so anything, because here there is no, if I could have sold it, so this one, if I could have sold this entire stuff, then what will, so in the first alternative, which is giving me 11,000 losses, 11,000 losses I could have incurred, 22,000 profit also I have received in between, and by the day of settlement 11,000 of losses, and it has also increased to this level of 16,570. So here question comes, I have the risk and the reward almost 1:1. If I win, I can win 1 rupee. If I lose, I lose 1 rupee. So what is the best procedure? What is the best procedure to initiate this one? So for that little bit of investigation we have to do, and we need to take the help of specific tools. So here I have taken this month's example. I have taken the example of Nifty future, which is closed on 5329. So as per my principle, I will be selling 5,300 call option, and I will be selling 5,300 put option, along with 5,400 call and 5,500 call. I will be forming a bull spread with the first alternative, and similarly I will be forming a bear spread with 5,200 put and 5,100 put. This is what I am going to do. So I will just check its performance with the help of my integrated tool. With the help of this tool, I will just check the performance of this strategy. If I wish to hold it for 5 days, 10 days, whatever may be, during this 5 days period, how the strategy will perform. So based on that performance parameter, I will be taking a call, and instead of waiting for a optimum profit or loss, if profit comes earlier, I can book it and come out. If the losses comes also earlier, I can book it and come out. So this is what I am going to explain with the help of integrated tool. Before that, spend a couple of minutes to understand our products, services and other things. So right after that, I will be joining you. And in the meantime, if you have any query associated with the subject, feel free to put it in the chat box.
With its applications in Indian market, with Indian market frontline stock examples, and book explains the various writings of Mr. Ranjan, and the book is being written by him only. The software, as you can see, we have written the practical, means for the trading purpose you can use, you can form various strategies by using the software, including Mr. Ranjan's famous innovation of beta decoupling software is available in the same course. So all these things cost you 1,700. The software tool what you were seeing just now called integrated tool, it is the number 8th product. It is the latest product of Smart Finance, which costs you 3,500 rupees and having lifetime validity, and you can do the future trade, option trades, commodity, equity, all kind of trading facilities will be there available. So that is called integrated tool. More about these features you can see in our website. If you wish to purchase this material, the cost is 18,250 rupees when you buy separately. However, we are offering 49% discount in the full package. That costs you 9,300 rupees. It gives all the material like 18 DVDs, 6 books and all the softwares. For purchase, you can either buy it online. We have the payment gateway available in our website. Otherwise, we have the franchisees over Mumbai and Gujarat. Please take down the numbers we have given here. You can contact these numbers and purchase on the spot itself there. Otherwise, from Chennai, you can take down the number from our head office also. You can make the purchase. Coming to our next upcoming events, we are having a lot of events in the month of August and September, free and paid events both. This is about the paid event, what you can see in the slide. It is a 1-month trading course we have designed, and people can take it online, otherwise offline. For Mumbai, we have offline, that is 1-day theory session will be there, where Mr. Ranjan will be going there for 1-day lecture session, morning 10 to evening 4:30 p.m. Date is 16 September. And online batch, we have 3 days theory session, 7 p.m. to 8:30 p.m. in the evening. Anywhere in the world you can sit and you can join. The way now you are attending the live sessions, the same you will be attending. This is about the theory session for the seminar participants. It will be followed by practical session, where during market hour for 5 days, we will show you how to follow these techniques, how to adapt, and what are the adjustments to be done during live market hour. That will be for the 5 days. It will be followed by another 1 month intraday, daily intraday call, and 2 option strategies from Mr. Ranjan's desk directly will go to all participants by SMS to their mobile. So you can see practically how it is being used. And there will be a follow-up discussion for 1 month, where every Friday weekend, once in a week, you will be getting the opportunity to sit with Mr. Ranjan and discuss about the calls, recommendations, what he has given, with reasoning and analysis of those calls we will be seeing. So all these things will come along with all our study material, as I explained you just now, at the cost of 13,500 rupees. I repeat, all the study material worth 9,000 rupees, 9,300 rupees, and all these seminar events will come at the cost of 13,500 rupees. Without material, if you wish to join, then 9,000 rupees will be the cost, and this fee structure, as I explained you, is valid till 31st July. By 31st July, this fee structure is valid. Then after, it is going to be raised. For seminar inquiry, please contact these same numbers, Chennai, Mumbai and Gujarat. Our representatives are there. They'll let you know in detail. And if you wish to register, then do not wait till the 31st July. You register now itself, so that you will get all the materials being sent to you within a day or 2, so that you can go through the material very well. You have ample time with you to come prepared to the seminar then after, so that better advantage you can take of your participation. Any query related to the product, please put in the chat box. From Bangalore,
So I am expecting this much of premium I have received from this operation. I am expecting the optimum I can go till 5489. Minimum I can come down 5169. Below this, my position will be at a losses. Future position is at a losses, which I don't want to take it head on. If it goes till 5489, beyond that, my future position will be profitable, but call option will be at a losing trade. So I do not want to carry my position beyond 5489 or below 5169. At these 2 positions points, I just want to check what will be the probable price of these options. I have checked it, and I have checked it all these options, what it will be trading at that particular time. And I have fixed off maximum 5 days period I am going to hold this position. During this 5 days period, I want the Nifty to touch either of this level. If it is not touching none of this level, I will be quitting the trade. I will not hold on this trade. If within 5 days period, starting from the coming Monday, if it is not touching, by the next week end Friday, if I am not touching 5489 or not slipping to 5169, I will just close the position and come out. This is the reason of keeping a 5 days period. You have to fix up a timetable. How long you wish to hold. There is nothing wrong if you can keep 7 days. Nothing wrong if you can keep 10 days. That is your scale, your command over the position. Option strategy, whenever you are initiating, you fix everything. You fix how much I am going to lose. You fix how many days I am going to hold. You fix what is the profitability I can get and what is the liability I can get. That is what our aim is. So these two levels, expected levels, and in these two expected levels, what will be my profit and losses. So conversion part first heuristic. This is future we bought. So this one minus this one. So this will be our profitable position. So this future part is over. Then we sold this option. So we sold this option. So 95 we sold. It is coming to 225. This is a losing position. Again we sold 65. So we sold this one and it is coming down to 18. So it is a profitable position. This entire one lot we have taken. Entire thing we have taken one lot. Multiply it with 50. Multiply it with 50. So 3,800 rupees we can get the profit from this conversion. If the same thing goes against us, so what will be the liability? So we have bought, it has fallen. So this minus this one. Added with, we have sold, it has, this is a profitable position. So this minus this. Again, this part we sold, this, and this will be a losing position. This part, this entire stuff, we have to multiply it with 50. One lot we have gone for. So if this kind of scenario happens, our liability on the conversion will be 8,900. Our reward will be 3,850. Option position we have 4 lots. So 4 lots, call option, which is taken here. This minus this one, added with, we have sold this one and it must come down to 80. So this again we have a bear spread. So we bought and current price will be this one. So this minus this one, and we sold the other one. So we sold this part, this minus this one. So entire stuff we have taken 4 lots because that much of money we have spent only. So 200 we have to multiply. So rewarding, total reward comes to 8,950, and same way this part also you have to check it. So here call option part, call option, we have bought it here. So this will be at a losing strike, and this is 0, almost 0, because this is a mispriced we got. So this will be a profitable position. We sold this part, 5,500 call option, and again we have the put option side. This we bought, and we have one more put option part here. We sold this one. So this minus this one, you can say this entire stuff, 4 lots we have taken. 4 lots we have taken, multiply it to 200. So 1950. So if I can add on this one, so this is my risk and reward. For 5 days period, with this first combination hybrid approach, if I win, I will win 8950. If I lose, I will lose 7,000. I am going to hold it for 5 days. and this will be my strategy. And I am expecting the Nifty to be in this range. Either it will give me a winning side at 5489, or it can give me a losing side at 5189. So so by the way of means the investment, that is brokerage means something you have to pay in terms of so if Nifty goes below 5169, then you can say your strategy will be at a loss, and losses will increase. If it goes above 5489, profitability will slightly increase, but not in a much extent.